economic recovery is important to the bank in terms of credit quality. I'm a director of a national bank, and what we are primarily concerned about is that economic recovery, in terms of improving the portfolio, commercial portfolio, real estate, as well as credit portfolio. The big concern concerning the banking industry, and I'd like to hear what the other colleagues have to say in the panel, is the hyperactivity of the federal government. I mean, we should be allowed to clean up the portfolios, to restructure the bank debt, but then we're throwing in all this financial regulatory reform and consumer credit reform. The due diligence that the banks have to make is a deadweight cost to the banks. That's increasing very rapidly too. So that hyperactivity, well-intentioned, I'm not saying of the federal government, in terms of regulatory reform, is a key concern.
Tony, I'm sure that you and I worry as an investment banker that my industry, your industry, right now we've lost our voice in the debate because my reading of history, the thunder of Congress and their ability to assign blame anywhere they can other than themselves drowns out and makes it tough for the industries to make their case. The public's memory, I think understandably, is pretty short in a media-driven world. So I think if you stop 50 people on the street, 48 of them think the commercial banks, the investment banks caused all the problems we have. And Congress is really in there helping people. And so I share that because the truth needs to get out. Financial services is already the most regulated industry in the United States, possibly the exception of pharmaceuticals.
There are aspects of financial services that were not terribly regulated, however, and we're talking about the various hedge funds and private funds. And I think a lot of people would say that was a big part of the problem here, and not saying that the banks themselves were part of the problem, but a lot of what was going on was these kind of feeder funds and types of stuff, funds that led to the Madoffs and the Stanfords of the world, and people have lost confidence, if you were to say, and so to the extent there's efforts to increase consumer and investor confidence, wouldn't that be a good thing? Obviously, it would increase the cost of doing business and
I think I understand where you're coming from. I think it's wrong-headed. I think the emphasis always should be on educating the public. I said at this last conference, my sense is the financial IQ of the average American is abysmally low. And regulating evolution of business, hedge funds, regulation will catch up to that. But if you don't have an educated populace,
I think it's a matter of the process of the regulation. In other words, it's like we're throwing the kitchen sink on everything at once at a time when there's uncertainty and we need to restructure balance sheets. In other words, there's a process that needs to go through this. And it's not just regulation in terms of financial supervision. It's also consumer credit, the Bank Secrecy Act, the cost to the banks of FDIC insurance, especially the smaller banks, regional banks who have little to do with the current financial meltdown that took place, is becoming increasingly larger. Actually, it's becoming almost a second or third element, FDIC insurance, in overall costs of bank operations. So, because we're paying certain taxes and all kinds of different premiums to be able to nurture the FDIC fund. And as a result of that, the cost of doing business in banking is increasing when the credit portfolios are still in the workout stage in many areas. So on top of that, you add the uncertainty of financial regulation very quickly on all areas. That creates a difficult problem for the financial institutions.
I agree with you, but I'll say that when we created financial devices like a structured investment device, it's a piece of confetti. We all understand, like in the CMBS market, what strips are. They're easy. It's whole loans. You can recover these kinds of things. But when I take those whole loans and I create confetti out of them, and that confetti then goes throughout the world and it's unrecoverable, we do need a reform.
Sure.
Because to allow the proliferation of that kind of device, which the people that created it, the smartest guys in the room, as is always said, can't put it back together. And we have, I mean, that's where I think that the regulation really needs to be. I agree with you about the cost. Unfortunately, we're having a balance right now going on in Congress where it's like, okay, the banks created some of these problems, the banks are drawing on this money, they need to replenish it, which is the old pay-as-you-go system. So you're right, the timing is bad. We do have to replenish what we have in the FDIC, for the reserve funds that have been gone. And thank God it's not 1991. I mean, we all remember that. And, when banks were going out, I think we all thought that the fund was going to go away too. But we haven't done the RTC thing yet, which is really wipe out tremendous amounts of money in terms of, our equities. Bush administration did a real good job of that, taking out all the investment houses as well as taking out Fannie Mae and Freddie Mac. And we've watched hundreds of billions of dollars in equity disappear because of bad regulation.
I agree with everything that you're saying, except for the fact that, fixing the problem doesn't necessarily mean you have to add more federal regulatory
I
agencies.
agree too.
I think that by the same way that banks are restructuring, looking at what the world's going to look like 3 to 5 years from now, these regulatory agencies which have existed, which were there, which, lived through this problem the same way we did, and didn't see it and didn't correct it, didn't, blow the whistle, those are the same agencies that need to be restructured in order to catch these things. So,
and don't you think what's happening though? I mean, now I think all of us have come to understand that if you were a bank, you could go shop for the regulator of your choice. And, well, I go to the OTS because I pay them and then they'll give me a favorable response. And I think that if we can have a better balance in our regulatory, not an adversarial, but more of a cooperative regulation, I think that we'll become a lot better off, where people don't try to necessarily push the envelope too much, and the regulators don't nitpick it either.
I agree with that. I mean, I think no one, here is saying that we need sweeping broad regulations of the financial industry. What the concern is, as you were saying, is that you had these collateralized loan obligations being sliced and diced and sold out there, and people didn't really know what they were getting, and there was really kind of a failure in the market there. And that segment of the market really didn't have a whole lot of regulation, if any, in the various portions. And so to the extent you can address that without, and it is a balance, you do need to balance, and you don't want to hinder the growth of the financial institution.